Hello and welcome to interest.co.nz. I'm Gareth Vaughan and I'm here at Milford Asset Management with Executive Director Brian Gaynor to talk about the year ahead, 2014. Brian, you've written some interesting things in your Herald column on this year. You've talked about how it will be, it's a once in a generation year, like 1951 and 1974 from an economic perspective. That's probably a good place to start. Why do you think things are looking so rosy going into 2014?
Well, there's so many things coming together at the one time. You have the housing market is pretty strong, and that creates a lot of house building activity. You have the Christchurch rebuild. You have a net migration inflow, an awful lot of well-educated and skilled New Zealanders coming back to New Zealand. You've got the China boom. It is a concern, I guess, what's going to happen in China, but we are still benefiting both forestry and the dairy industry from it. The level of confidence is very high, and there's a new generation of business people coming through, as reflected by Xero and Wynyard and companies like that. So it's the best I've seen for a long, long time. In fact, the best I've seen for over 30 years.
Now, you mentioned China. China is obviously a huge influence on New Zealand these days from a trade perspective, also Australia. There are sort of mixed signs coming from those two countries. To what extent are you concerned that events in those countries this year could perhaps curtail some of that euphoria you see going into 2014?
Yes, it is a concern, and we do look at it very, very carefully. We spend a lot of time trying to gather as much information as we can from China. We have a Chinese-speaking fund manager here who kind of keeps us informed about the local media and the local press and what's happening over there. China is a very difficult country to get statistics on because it's a huge country, and when we talk about China, we tend to think it's all the one, but of course it's made up of different regions. We try to follow it. It is a concern, but the best we can say at this stage is a concern rather than a threat.
And what about Australia?
Well, Australia will suffer, obviously, if China goes down. But I've been over there twice already this year, and I'm reasonably confident about Australia. I mean, you are getting a pickup in the housing market. Some of the confidence levels are rising. It's not going to be as good in Australia as it was over previous years because, remember, they didn't have a recession during the global financial crisis. But should China take a big drop down, it will affect Australia. But at the moment, we're not predicting either of these, although we're keeping a cautious eye on them.
Now, a couple of things that people are also watching carefully going into this year is the New Zealand dollar and the strong hints from the Reserve Bank that it's going to raise the official cash rate this year. Now, the New Zealand dollar is particularly strong at the moment against the Australian dollar. Is that a big concern for New Zealand?
It is in some ways because it is for the manufacturing sector very definitely, but it's a benefit to most people. I mean, there's more New Zealanders travelling on holidays overseas because it's very cheap now to go to Australia and the United States and places like that. It's cheaper to import cars and other and electronic goods, so there are negative and positives. I think that our exporters have to learn to live with a strong dollar because in the end that's a reflection of confidence that there is in the New Zealand economy. But yes, watching the dollar, I hope the dollar doesn't go much higher. I would hope that around the level it is at the moment that it will peak, albeit it may not drop a lot unless there's some real problems in China and some of the other emerging markets.
Now, interest rates, obviously the Reserve Bank's got its first review of the official cash rate for the year this week. There's some talk that they might hike this week, but most economists are looking on to March. Interested in what your views are on, I guess, the prospect of rising mortgage rates, if indeed we get them, on the housing market and also on the share market, because the share market's had a couple of really good years and is still trucking along pretty well.
Yeah, the share market have two good years, but not great years, 23% and 16%, which I guess is good compared to what had happened in previous years. Interest rates. Well, you've got to mix interest rates against the level of confidence. I mean, back in the 1980s, for those who were around, those of us who were around then, interest rates got to 17 or 18%, and the share market was roaring upwards. So, under normal circumstances, you would have expected that to have a negative impact. I think that higher interest rates will definitely put pressure on people who've got high mortgages, particularly people in the kind of medium income group, and that may negatively impact retail spending. But overall, I don't expect that the increase in interest rates this year will have a negative effect on the economy, albeit it may do in 2015. But I think as far as 2014 is concerned, it's unlikely to have a major impact. But obviously, in the medium term, they will.
Now, you mentioned before off camera that you're getting a lot of requests for you to talk about the share market of late. It has had a couple of pretty good years. There's been a lot of excitement around the tech companies, the Xeros and the Wynyard Group, which you mentioned, and others.
Yeah.
I noticed last week in the Australian Financial Review there were two items in the Street Talk column on New Zealand tech companies.
Yeah.
What is your feeling about the share market at the moment?
Well, we're reasonably positive about the share market. I mean, the predictions we're saying is that it should have a return of maybe between 8 and 15% this year. Although we've been wrong in the two previous years because we were cautious and it was actually quite good. So I always say that. You never know about the share market. The reason why there's renewed interest in the market is because it's done well, but there's new companies coming along, these tech companies, which investors find quite exciting. Now, you need to get interest in the share market, you need a good performance plus new companies arriving on the scene. But not only have new companies already arrived, we've invested in 5 or 6 unlisted companies, and we see the prospects of 1 or 2 of them could list this year, and we feel that investors will find them quite exciting if they do list. So it's not just the companies have already listed, there is a lot of other tech companies in the background looking to list, which would have a positive view on the share market.
Any in particular that you would highlight that you think are particularly exciting that may come to market this year?
Well, I'm not prepared to say it at the moment because, you never know whether they're going to or not. But there's obviously ones like Orion, which is the IT company and the hospital healthcare companies like that, which if they came to the market, I think they'd get a lot of attention from investors. I mean, the good thing is we do have a lot of good tech companies. And why is that? I think it's because TradeMe and Xero have been so successful that there's younger guys who worked in those companies that have gone out and set up their own companies, and they've seen how to build successful companies. They've seen that you can actually do quite well for yourself and for your shareholders if you do get the right business model, and therefore I think TradeMe and Xero have had a very positive impact upon entrepreneurs willing to set themselves up and to try to repeat the success of those two companies.
You've been watching the New Zealand share market going back to the 70s now. I mean, how does this current period compare with I guess, some of the more bullish periods we've had in the past?
I'm much more excited. I know it's easy in retrospect, but I never got caught away by the 1980s. I found that was very false because it was property companies and it was investment companies which had very little substance to them. Now, I'm not saying that all these IT companies will be successful, because they won't. But we have genuine companies coming through that have a global reach and have the ability to be able to do well on an international scale. I mean, you can't go past the fact that, people are skeptical about Xero at the moment, but so are they skeptical about TradeMe. I mean, when TradeMe was sold to Fairfax originally by Sam Morgan, people thought the price was incredibly high. Well, that company now is worth substantially more than that. I do think that you have huge upside potential with well-run technology companies that have a good market penetration and know what customers want. So I'm hoping that the TradeMe will be repeated a few times. And if we were to get, say, 5 or 6 or 7 TradeMes, and Xero was to continue on the path it's going, it would be a huge fill-up for our share market, but also for the New Zealand economy.
Now, we've talked about interest rates before, but just curious as to whether you think rising interest rates would impact negatively on the share market.
I think it can eventually have an impact on the share market, but our interest rates are still incredibly low. We're only at 2.5% ROCR, which from a historical context is very low. I mean, I think interest rates could easily, and I'm talking about the OCR rather than mortgage rates, could easily go to 4.5%, which would be 8 quarter percentage rises before it would ever beginning to have a negative impact. Remember, we're at super low interest rates at the moment. So if we get back to the medium, which to me in the OCR is around the 5%, that's not negative. If we start going up to 7, 8 or 9%, well, that is negative. But that's only going to occur because the economy gets so hot that the Reserve Bank feels it just has to dampen down demand in the economy. So we've got a long way to go before we start talking about an OCR of 6 or 7%.
Now we'll move on to the housing market now. Obviously, house prices have been growing strongly, especially in Auckland and Christchurch in the last couple of years. We've got the Reserve Bank with these restrictions on banks' low equity home loans at the moment. We've also got the government and Auckland Council trying to get more houses built in Auckland. Just curious to see what your outlook is for the housing market this year and what sort of impact these two, I guess, attempts to bring house prices down will actually have.
Well, what we would hope definitely is as a big increase in house building, because this does two things. It creates economic activity and it increases the supply. And the problem with our housing in New Zealand is the lack of supply. That is the biggest thing. We're not getting enough new houses built, and we're not getting enough new houses built close to the inner cities. And it does appear that in Auckland at least, there is major efforts to free up land and to quicken the process which allows people to develop new housing. And you can see with the apartment building, you're seeing a lot of ads now in the paper for new apartment blocks going up. Some of them will be good, some of them will be bad. But this is what we need. I still think the housing market could be stronger this year. I mean, I know the consensus is 4.5% to 5% increase. I think it could be higher than that, because the thing that we're seeing more than anything else is returning New Zealanders. The external migration inflow is turning around quite dramatically, and that's one of the biggest impacts, particularly in Auckland, because 70%, I think it's more, isn't it? 90% of the people coming back are going to Auckland. So, Auckland housing market this year should remain reasonably strong, albeit I hope that the prices don't rise by more than 10%, because that's when you get into dangerous territory.
Yeah, well, everyone will be watching that carefully.
Yeah.
Thanks a lot for that, Brian.
Thank you, Gareth.
That's Brian Gaynor, Executive Director at Milford Asset Management, and I'm Gareth Vaughan at interest.co.nz.